The European Union faces a critical question. Can the Eurozone survive another debt crisis? In 2025, the economic landscape is, well, troubled. Alarming signs suggest a perfect storm is brewing, one that threatens the stability of the Eurozone. Public debt is soaring, economic growth is sluggish, and unemployment remains stubbornly high. This is not a drill. The situation demands immediate attention. Understanding the core issues is crucial for navigating the challenges ahead. Let's examine 5 key pressure points that are pushing the Eurozone towards the brink. The stakes are high. The decisions made today will determine the fate of the Eurozone. Will it weather the storm and emerge stronger, or will it crumble under the weight of its economic woes? The most pressing issue facing Europe today is the rapidly escalating debt burden, which has become a central concern for policymakers, economists, and citizens alike. As of the second quarter of 2024, the euro area's debt-to-GDP ratio reached a staggering 88.1%, highlighting just how much debt has accumulated in recent years. In practical terms, this means that for every euro produced by the economy, the government owes almost 90 cents, a level that puts significant pressure on public finances and future growth. The situation is even more dire when looking at the entire European Union, where the debt-to-GDP ratio stands at 81.5%. This level of debt is widely considered unsustainable by most economic experts. 6 EU countries, France, Italy, Greece, Belgium, Spain, and Portugal, now have debts that actually exceed their entire annual economic output, with debt-to-GDP ratios over 100%. Such high debt levels severely limit these countries' ability to invest in essential services, maintain infrastructure, and respond to new challenges or emergencies. Moreover, the cost of servicing this massive debt diverts valuable resources away from crucial areas like education, healthcare, and innovation, making it harder to improve living standards or compete globally. This vicious cycle of high debt and limited investment stifles economic growth, perpetuates stagnation, and leaves millions of Europeans facing an uncertain future. The Eurozone's economic engine is sputtering. GDP growth in 2024 was a meager 0.9%, barely registering a pulse. While the last quarter of 2024 saw a slight uptick to 0.2%, the overall picture remains honestly pretty bleak. This sluggish growth is a major concern. It limits job creation, dampens investment, and erodes confidence in the Eurozone's future. The reasons for this anemic growth are complex and multifaceted. Global uncertainties, trade tensions, and internal structural issues all play a role. Addressing these challenges is crucial for reigniting growth and securing the Eurozone's long-term economic health. Despite a slight uptick in 2024, unemployment remains a persistent and deeply rooted problem in the Eurozone, affecting millions of people and their families. The unemployment rate stood at 5.9% in December 2024, which is still significantly higher than pre-pandemic levels, highlighting the slow pace of recovery. This figure actually masks significant disparities within the Eurozone, with some regions faring much worse than others. Countries like Spain and Greece continue to grapple with double-digit unemployment rates, especially among young people who are struggling to find stable work. This situation fuels social unrest, erodes human capital, and undermines the Eurozone's social fabric, making recovery even more challenging. Creating jobs and providing opportunities for all citizens is, honestly, paramount for the future stability and prosperity of the region. Failure to do so risks creating a lost generation and, exacerbating existing inequalities that already threaten social cohesion. Adding to the Eurozone's woes is the persistent challenge of inflation. While inflation cooled slightly to 2.5% in March 2025, it remains stubbornly above the European Central Bank's target of 2%. This sustained price pressure erodes purchasing power, reduces consumer confidence, and complicates monetary policy decisions. The ECB has responded with a series of interest rate cuts, lowering the main rate to 2.25% in April 2025. However, the effectiveness of these measures is limited by global uncertainties and the risk of further inflationary pressures. Finding the right balance between stimulating growth and keeping inflation in check is, well, a delicate balancing act. The impact of these economic challenges is frankly evident in individual countries. Across Europe, daily life is shaped by the realities of inflation, rising costs, and uncertainty about the future. For many citizens, these struggles are not just numbers on a chart. They are felt in job security, public services, and the overall sense of stability. Greece, still reeling from its sovereign debt crisis a decade ago, faces renewed pressure. The scars of austerity measures linger, and many families continue to feel the effects of years of economic hardship. Despite some progress, the path to recovery remains steep and uncertain. Its debt-to-GDP ratio remains above 170%, limiting its fiscal space and fueling concerns about its ability to service its debt. Investors and policymakers alike watch closely, wary of any signs of instability that could ripple through the Eurozone. Italy, with a debt-to-GDP ratio exceeding 140%, is another country in a precarious position. The government faces tough choices as it tries to balance growth with fiscal responsibility, all while navigating a complex political landscape. Its sluggish growth, political instability, and high borrowing costs raise concerns about its long-term sustainability within the Eurozone. Italian citizens worry about job prospects and the future of their economy, as leaders debate the best path forward. Germany, the Eurozone's economic powerhouse, faces its own set of challenges. Even with a strong industrial base, it is not immune to the pressures facing the continent. While its economy remains relatively robust, it is grappling with the political fallout of increased defense spending. The decision to boost military budgets has sparked debate among politicians and the public alike. The need to meet NATO targets and contribute to European security efforts is straining its budget and sparking debate about debt sustainability. As Germany weighs its commitments, the broader question remains: how can Europe balance security, growth, and fiscal responsibility in these uncertain times? The Eurozone stands at a crossroads, facing one of the most challenging periods in its history. The convergence of rising debt, sluggish growth, high unemployment, and persistent uncertainty has created a climate of anxiety across the continent. Inflationary pressures and volatile markets now pose a significant threat to the stability and prosperity of the region. Ignoring these mounting challenges is not an option for policymakers, businesses, or citizens. The path forward demands not only collective action but also a renewed sense of purpose and a shared commitment to meaningful reform. Fiscal prudence, structural reforms, and deeper economic integration are essential for navigating the turbulent waters ahead and restoring confidence in the Eurozone's future. European solidarity and unity are more critical now than ever before, as nations must work together to overcome adversity. Addressing the root causes of the crisis, fostering innovation, and supporting entrepreneurship will help drive sustainable growth. Investing in education, job creation, and advanced industries is crucial for securing a prosperous and inclusive future for all Europeans. The time for complacency is over. The urgency of the moment calls for bold decisions and courageous leadership. The Eurozone's survival depends on decisive action, unwavering commitment, and the willingness to embrace change for the common good. Together, with a shared vision for a stronger, more resilient economic union, Europe can rise to meet this historic challenge. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.